The nature of student debt is sort of distinct in some ways that might actually be important for politics from other kinds of personal credit that you might have. And so almost any other kind of credit that you could get, whether it's a credit card, whether it's an auto loan, whether it's a mortgage, to buy a house, essentially you're using this credit, you're getting access to some sort of borrowing in order to get access to a tangible asset. What's really important about the tangibility of that asset, the thing that you're buying, is that means it's also something you can maybe sort of sell on again, especially if you get into sort of trouble. The funny thing about student debt is that if you think about what's the thing you're buying with it, right? Well, it's a degree, it's human capital, it's an education. And so while of course that has a value, we think that hopefully you're all going to go on to college. That's going to give you lots of skills that will be useful when you want to get a job and in the marketplace. But that degree that you get with it at the end of those 4 years in college is not something that you can then sell if you get into trouble, right? So you lose your job, you can sell your house, you can sell your car, you can't sell your fancy degree from Harvard or wherever. And so what that means is that the nature of the asset that you acquire with student debt is distinct from other kinds of credit markets. And in particular, it's a non-tangible asset, right? It's not something you can physically hold. And that also means it's a non-transferable asset. It's not something that you can sell to other people. And that then affects kind of the nature of how sort of student debt markets operate. And one of the really important ways in which it operates is, again, because the thing that you've bought with it is not a physical, tangible object, that means that essentially it can't sort of help ensure, let's say a bank, when it makes a loan to you for your house, again, the concern is, well, even if you can't pay back your loan, the bank gets to acquire that house essentially as a form of collateral. And so if you go bankrupt or you default on your debt, the bank gets the house, the bank then just sells the house and it makes its money back, and that helps insure the lenders against the risks that you might not be able to pay it back. Well, again, that's not the way that student debt really works. Again, if you get through 4 years of college, and then you default on your student debt, if you decide you're not going to pay it back, the bank can't take your degree back and then sell that in the market to help it get the money back that it lent you. And so again, this sort of poses an extra source of risk to lenders. And the way that has sort of worked itself out, particularly in the United States, but also in a lot of other countries, is that's meant that the legal sort of environment surrounding student loans and your ability to default on your student debt, to basically not pay it back, it's incredibly onerous to do that in this country.